Hi everyone, and welcome to Swissquote's Daily Market Talk. We are Wednesday, January 21st. Markets are pressured by a mix of geopolitics and bond market stress as tensions over Greenland collide with a sharp sell-off in Japanese government bonds. Global yields push higher, European and US stocks are pressured, precious metals continue their rally, and with Mr. T expected to rock the boat in Davos today, the only certainty is uncertainty. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So an exotic blend of rising geopolitical tensions between the US and the European Union over Mr. T's willingness to buy Greenland, and a major sell-off in Japanese government bonds in the context of Japanese PM Sanae Takaichi confirming that snap election on February 8th in hope to consolidate her power at the heart of the government and throw more public money onto the Japanese economy rattled the global financial markets since the start of this week. The Japanese 10-year yield flirted with the 2.40% level yesterday, while the 30-year yield jumped more than 25 basis points, which is a huge jump, mind you, past the 3.90%, while the 40-year yield jumped past 4%, a level that has not been seen yet since the 40-year bond exists. The selling pressure eased this morning and the yields are lower, but the violent move that we saw there almost made investors forget about the US bill to buy Greenland. Almost. They did not forget, of course. In the FX markets, the US dollar and the yen bears raced each other to see who's shorting faster. The dollar bears were ahead yesterday. The dollar yen fluctuated around the 158 level, while the US dollar index fell the most in 10 days. This morning, calm reigns. The euro dollar is consolidating around the 117.15 mark, for example, up from around 115.80 at the start of this week. On the government bond side, the US 10-year yield shortly traded past the 4.30% level yesterday as global investors continue to abandon their US holdings, worried that 1. The US becomes just too aggressive these days to call them an ally and their government debt a safe haven. And 2, the exploding US debt levels are unsustainable. The good old US debt story, perhaps also fueled these days by the worries that the military spending in the US must rise if the US starts using its army to conquer the world. Bad news is that elsewhere, appetite in government bonds didn't look much better either. A benchmark for the European 10-year yield rose yesterday, along with the cracks among the European Union members facing a differential US treatment over the Greenland story. Only a handful of them are being subject to fresh tariffs, remember, not all of them, and that's creating some tensions among them, obviously, due to diverging interests. So we could hear the German Chancellor this week say that it's normal that the French are more sensitive to the US tariffs and they react more, while Italy tries to mediate the dispute with little conviction, however, from the European peers so far. So this Greenland chaos will remain the main course of this week and will be served today as Mr. You-know-who is preparing to rock the boat in Davos today. The rally in gold prices to $48.76 per ounce level, a fresh record high, is a good indicator on how uncertain and how tense the markets and investors are feeling today. I hope I am wrong, but there is a greater chance that the two sides of the Atlantic Ocean won't reach an agreement over Greenland in a day. I mean, look, the UK and Irish took almost a decade to reach an agreement on fishing rights. Here, we're talking about a matter that could mark the beginning of the end of NATO. The implications would be huge, so huge, in fact, that nobody really knows the extent. What we know, however, is either way, the Europeans will have to strengthen their defense. All members must set aside a budget for heightened military spending in the coming months and coming years, and that regardless of who gets the tariff military hit today, because tomorrow will be someone else's turn. So capital continues to flow into the European defense stocks, while on the index level we see the sales weigh heavier. Across the Atlantic Ocean, the market mood is not better. The major US indices got lower at the holiday shortened week's open yesterday, which is a healthy thing. It is a sign that investors sometimes do care. The S&P 500 lost more than 2% yesterday to catch up with the sell-off that we saw in Europe the day before, while the technology-heavy Nasdaq 100 index lost more than that on fears that the tensions with the EU could finally force Europeans to pull the trigger and tax the US big technology companies. Now, the mood is a little bit better this morning, judging by the small gains that we see across the US futures at the time I'm talking here, and taco buyers are waiting in ambush to jump in, but the tensions are not ready to go away just overnight. I believe that they will cast a shadow on this earnings season, unfortunately, because these tensions will be adding to the long list of things, of worries with which investors are growingly uncomfortable. As I say, and as I repeat every day, those are the circular AI deals, the over-leveraged AI investments, the delayed ROI, go on, you can say with me, the rising metals and memory chip prices, and so on. So I'm not sure that the earnings will be soothing these worries. On the other hand, we also know that the headline numbers will be put to test as investors will be looking into the details of these numbers. Has Nvidia turned their account receivables in cash, for example? And what are the real exposure of these AI companies, these technology companies, to each other in the context of everybody's hand is in everybody's pocket? Now, speaking of earnings, Netflix announced that it amended its offer to buy Warner Bros. To an all-cash offer, which would be just simpler, and announced its fourth quarter earnings yesterday after the bell. The company narrowly beat earnings and revenue estimates, as revenue, for example, grew more than 2.5 times from last year, they said, to over $1.5 billion US. This is a thing that could eventually help OpenAI to generate easy cash, as it is also preparing to bring advertisement onto its free chatbot, if this is any comfort to investors. But the shares of Netflix fell last in the after hours trading as the company warned of higher program spending and costs involved in the purchase of Warner Bros. The good news is that Netflix does not have this global influence, so the results are just for them and just for those who want to buy or sell these shares. Moving forward, we will keep an eye on the Greenland story, obviously, it's impossible to miss it, but also on the Japanese yields and on the upcoming earnings. The only certainty again is uncertainty. As a result, the stock market volatility is rising, and the bond market volatility, which has been falling due to strong demand for all kinds of bonds since last year, will also likely rebound from the lowest levels that we saw since last quarter of 2021. It's important here to note that DM, so developed market sovereign bonds, do no longer offer the diversification that you need right now. They actually do remain under the pressure of rising geopolitical tensions that will increase the need for more security spending from these developed market governments in a context where debt levels are already not sustainable since a while, since the pandemic months precisely. So where do people go? Well, they go to gold, they go to silver, they go to copper, they go to industrial metals, they go to rare earth metals, because the US and China trade war has been pushed to the second headlines, but it is still ongoing as well. So in summary, people go to anything that's tangible. They go to hard commodities. And what's interesting is that Bitcoin, for example, had no say whatsoever in this flight to hard commodities and supranational assets. I would have expected to perform better, but seemingly Bitcoin is more suffering from its closeness to the technology stocks rather than benefiting from a potential safe haven and supranational asset status. Oh well, the digital gold is not yet gold. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, X, LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading and have fun watching Davos.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.